Justin, welcome to the show. Bit of a personal question here. I'm curious to know, what was your first ever investment?
It was a house up in Toowoomba, $200,100. And I shopped around, was reading so many books, going to workshops, seminars, just trying to understand real estate as much as I could. Worked 3 jobs, 7 days a week, picked up this property for $200,100. I knew it was so far below market value that 3 months later got it revalued. It had gone up 30%. So now it was 260. Could redraw the equity, go straight into the next one. Obviously, just keep compounding, building that portfolio. Now going to developments and doing all these creative stuff. But it all starts with that smaller one. There's no substitute for experience as well.
Have you still got that property?
I actually sold it a couple of years ago. So a few years ago, this is how I actually got into this industry. Is I sold quite a large proportion of the real estate. Didn't need to work for a few years, and wanted to go back into an industry where I can learn while I earn. And that's realized property investing was always my passion. Now I get to do it full time, which is great. So just being able to help people and just some of the results we're getting people is just that's the fulfilling part.
Okay, so that's how you got into the industry itself. What about the investor agency? How did you come about that?
Yeah, so I used a couple of buyers agents to build my own portfolio. Obviously, did a lot myself as well. When I sold that proportion of my portfolio, didn't need to work for a while. Realized I wanted to get into the industry so I can learn while I earn. Shopped around, found this one company with the tech, the AI was just a whole nother level. No one had really heard about it, and obviously joined the company. I was pretty fortunate. Within about 6 months, I was able to actually become one of the owners of the company as well. One of the founders left, so I was able to buy into the company. And then just last year, we grew from 8 to 22 people, had to move offices 3 times in 9 months. So it's been quite exponential. So I've been here for about 3 years now. And I think the company's been around for about 7. So yeah, it's obviously doing really well. It's turbulent times at the moment, but I think it's just going to weed out a lot of all the cowboys in the industry. So,
Yeah, 8 to 22 employees. Why do you think you've got that growth in the last year?
I'd say a lot of the things that really separate us is the AI, it's the machine learning. I can even show a little snippet of what it looks like, but we analyze every suburb of the country, or 15,353 suburbs. Every suburb's on a different growth cycle, so we know when to get in and out. Last year, the average growth to everyone was 24% growth in the first year. It's all about building a strategy. Not one property is going to make you wealthy. Everything we buy is to get straight to the next one after that. Having the exit strategy, knowing to focus on wealth creation before cash flow. So really understanding, I guess, everyone's personalized situation, their strategy, what their goals are, and how we're going to get that, rather than just being those one and done buyers agents. And I think just our tech is just so much further ahead, which, yeah.
Out of those 15,000 suburbs, right now, how many do you think are actually good investments?
Yeah, so we're only buying at about 70 at the moment. So,
Yeah.
and go more into about the ethos as well, because as I said, we buy between about 500 to a million. Reasons for that, we go too much higher than that, just becomes too far negative cash flow, hurts your serviceability for the next one. Anything below that at this moment, maybe even below 450, it's just too high risk. Property's all about demand and supply. Don't want to be buying out in those rural areas where it could sit on the market for a year or two. We want to buy in an area where there's just the biggest bell curve of people trying to target those assets. So, and I said, we're only buying houses, ideally 500 square meters. Don't touch any apartments, house and land, none of that developer stock. The real money's in the land. We're trying to get as much land in areas where there's a scarcity of land. So I can even tell you more about where we're buying and why those areas, if that helps.
Before we go into that, the 70 suburbs, do you think there's a minimal amount right now because of the federal budget?
So with that, it's a bit of a broader answer as well. So we feel everyone's serviceability has been hit by about 20, 30%. So now everyone's been starting to push into that price of about 500 to a million. That's the only thing people can really afford at the moment if they're on an average income.
Yeah.
Secondly, with negative gearing being taken away, cash flow has now become more important. So we need to get higher yields as well. And so negative gear hasn't been taken away. It's just been moved on where and when we can claim it. So we are finding it is getting tougher, but there's so many people sitting on the fence at the moment. We can't almost feel it's like the early stages of COVID, the first 6 months where people are unsure, so many great opportunities. At the end of the day, property is all about demand and supply. There's just not enough supply for the demand. And I think the two things that fuel the market, it's economics and emotions. Emotions are pleading. The emotion and sentiment right now is a bit shaky, but the economics haven't changed. The fundamentals are there's still a lot more people moving into the country, 3,400 a day, than there is available houses being built. It's now taking longer to build a house than what it did 30 years ago. So we just can't keep up. And it doesn't matter if someone buys or rent, they still fall under that umbrella. They still need a place to live. And even in turbulent times where I guess the market might be taking a hit, it's the last thing people sell is their house. So we're trying to hold on to that for as long as possible. Real estate's a necessity rather than, I guess, shares, bonds, things of that sort. So it always bounces back if the economics and fundamentals are right in the areas that we're buying.
Yeah. You basically touched on this, but I want to get a clear answer. Is property still a good investment post budget?
Yeah, 100%, I think so. First, the biggest thing is the ability to leverage an asset to that extreme. So obviously you have 100 grand put into shares, it returns 7%, you've made $7,000. You put into property, borrow the other 900,000. Now you've got $1 million asset that grows at 7%. You've made $70,000. So your cash on cash return, which I think people don't look at enough, is 70%. 70% in 1 year is just insane. So there's that. And then secondly, it's just always the necessity, as I was just touching upon there as well. It's the last thing people sell when markets are shaky.
Yeah. The way I see it, it's the fundamentals of property haven't actually changed. There's a few different tax outcomes that have been across the board anyway, but property is still property. There's still a supply and demand issue.
100%. And negative gearing should never be a strategy as well. For those properties that we do have to kind of negative gear in those early stages, obviously the growth will far outweigh that. The goal is always to get out of negative gearing. It hurts your lifestyle, it hurts your serviceability. There was that tax benefit and still is, just at a different time now. As I said, the real money is always going to be the capital growth when it comes to residential, and that's what we need to be focusing on before we go to those cash flow type assets like commercial, apartment blocks. For those ones, you want to be entering minimum 2 million and up. The reason for that, below that, they can become a bit high risk though.
Yeah. Yeah, that checks out. Okay, that's good to hear. Has there anything changed about your investment strategy post budget?
Not so much. I guess for us, the economics, as I said, hasn't changed. Fundamentals are still the same. The emotions will always go and come. Even with interest rates, you marry the property, not the interest rate. So you really want to select the right property rather than getting too fixated and try and get in and out of market based on an interest rate. So it hasn't really changed too much. If anything, we've broadened the range. Through our AI, we can now, as I said, analyze every suburb in the country, know when to get in and out of markets. So we have actually broadened it down a little bit on the lower end of the scale. And we can get into those markets like where they could double in 5 years, much higher rental yield, but they're the ones where you might want to pull out after 5 years, take the money, reinvest into an emerging market. Whereas before, we're simply buying in markets where we're saying don't sell unless your serviceability runs out or you're transitioning from wealth creation down to cash flow, where you're liquidating your portfolio. Now you go into those cash flow assets, entering in a much higher starting point because you've got so much more capital now to play with than when you did at the start. So yeah.
Do you think a certain price group has been hurt by the federal budget?
Yeah, I'd say it's like the upper middle class because, you know, if you get over $7-10 million, especially with the interest rates, they doesn't really affect those markets by any means.
Yeah.
A lot of those people are buying in cash. When you're at that luxury end of the market, it's you know, you've got enough money, you can do whatever you want. You're buying properties with, especially around Bellevue Hill, Double Bay, Vaucluse, Chirac's the exact same as well.
Yeah.
The markets we're buying that 500 to a million, people have kind of been pushed into that market because their serviceability's dropped. It's more around that $1.5-2 million, maybe 3 million. They're the ones that are going to be taking a hit. Large mortgages, still good incomes, but big mortgages, they won't be able to afford it too much if they can't claim those negative gearing benefits in the financial year.
Yeah.
So we're kind of finding that it's probably the market that's going to take a hit. And we're starting to see via the data, the suburbs that are dropping the most around that $2-3 million mark.
Yeah. And you buy from around 500 to a million. That's your preferred price.
Yeah, exactly. It just gives the balance, capital growth and cash flow.
Yeah.
Growth gets, so they say yields keep you in the game, but growth gets you out of the game. We still need strong yields.
Yeah, I like that.
We need strong yields to keep on building that portfolio. Real money is always going to be in the growth though. So we need to find that balance. That's where people get stuck. They leverage too much, haven't got the serviceability because their debt to income levels have maxed out. So that's why it's all about having the strategy. Everything we buy is to get straight to the next one. And we need to kind of plan a few properties ahead.
Yeah. Okay. How important is sequencing to serviceability?
Without serviceability, you can't really buy unless you're putting cash offers, which we wouldn't really recommend because the biggest benefit to real estate is usually the ability to leverage so much. So serviceability, it is key, obviously thinking one ahead. If people have bought in their personal name, if they get maxed out, then they can't buy in a trust. So it is trying to really think what's the best way, obviously from an asset protection, a tax, but to be able to build that portfolio It's not one property that's going to make you wealthy. It's having multiple, the compounding effect of having multiple properties diversified into different states. So you're always getting growth at one point and you can keep redrawing the equity, get into the next one again. So
Post budget as well, they've hit a lot of people with the tax in the personal name, but with the structuring, you never had the 50% discount, at least at the company.
I think they've made it more complicated because I guess that's what people are really doing it for, obviously, to kind of help themselves get ahead. So they don't have to rely on the government once they retire. So if anything, just speaking to a lot of accountants and they're saying, well, trusts were the go-to. Now it's probably companies. However, if a new government gets in and everything changes straight back, now they have to transfer entities, but obviously you have to pay stamp duty then. So it's kind of, people are unsure just because I guess the roller coaster of changes we're going through. And as I said, all the other governments are coming in saying, if we get into power, we're going to change everything straight back. So it is finding something a little bit more universally, but it's more about understanding the end goal. What's the end goal? It shouldn't just be to reduce your taxes. It should be building a sizable portfolio that they can have an exit strategy for, rather than just trying to think short term and where can I just get the most amount of tax benefits. It's what's my end goal and how can we reverse engineer it and what's going to be best for that.
So recently I've had clients pull out of property purchases. They've been holding off or have just fully gotten out of the deal. Do you think there's any justification for pulling out of those property purchases?
As of right now, we're seeing some incredible opportunities. It's quickly turning into a buyer's market. It's what we're trying to say. If we can capitalize on this market right now where there's so much fear in the market, vendors are wanting to sell quickly, there's still people out there that need to liquidate their portfolios, and we can capitalize on that because there's not enough buyers in the market at the moment. Then hold it throughout this time. You only lose money when you sell. I think obviously inflation alone is devaluing the debt. As inflation enters the market, obviously it's devaluing your dollar, but it's also devaluing the debt. And again, that's what makes real estate great. And if you can hold it for as long as possible. The other thing as well, they've now said this is the biggest quarter in rent increases they've seen in the last few years. If we look at what's happened to the New Zealand market, same things. They brought in getting rid of negative gearing in the taxable year and also capital gains tax. With that being said, the rents skyrocketed. We're now starting to see that replicated here as well. That's going to make it easier to hold. It'd be incredible if we can start getting back to seeing positive cash flow properties. So therefore, it's not holding you anything. It's producing income whilst it's growing, whilst the debt's being devalued by inflation. So we think it's a great opportunity right now to be buying.
Yeah, it's a hard concept for people to understand, but the same as the dollar devalues with inflation, your debt is also shrinking. So the longer you hold debt, the smaller that debt gets in relative terms.
It's what we try to explain to people. $100,000 in 1980 was a lot of money. $100,000 today, it's not a huge amount, but $100,000 debt in 1980 was a lot of money. $100,000 mortgage today, it's not. It's a joke.
You touched on investor emotion. The investor agency, they use a lot of AI. So in my mind, that actually takes a lot of the emotional decision of buying property out of the equation. Do you think that benefits the purchasers?
Yeah, absolutely. I can even show you just all the different anomalies. We're looking at about 2 billion data anomalies every single month. So the GDP, GSP, GRP, available housing, housing income, economic drivers, infrastructure projects, even our housing plans of impacted areas, and seeing how that will impact future areas as well. We kind of realized that the last 3 years would dictate the next 3 years, just because when a market starts to move with its population, infrastructure, employment, it takes a while for all that to kick in. So therefore, I can even just show you how detailed the text got in.
That'd be great. Let's run through it.
Yeah, perfect. This is Crystal AI. So this, as I said, analyzes all 15,353 suburbs every single month. So just this top column here, it shows us the top performing suburbs for every single category. So this suburb in Northern Territory grew 70% last year, which probably wouldn't touch that. Could clearly be a mining town. But if we zoom into Victoria, that's just starting its cycle. You can actually see what each suburb is going to grow over the next 12 months.
Yeah.
Probably the best example would be Western Australia. Obviously, you've seen what's happened to the property market in Western Australia over the last 5 years.
Yeah.
Yeah. So this suburb, Calista, 30 minutes south of the CBD. I'm just finishing off a development there, but you can see even in the last 12 months, it's still grown 22%.
Yeah.
But what I did want to show is just the projections. So in the next 12 months, it's still going to grow 17.5%, but then it starts to plateau. So each market has to come to the end of its cycle where people can't afford to pay any more. The supply's catching up the demands. There's a whole number of different factors. The AI will actually break it down year by year what's happening. But
Yeah.
we can see how gentrified an area is, how educated people are. So it's incredible in that regard. And then we can do this across every suburb in the country. We can see how units are affected, housing, whatever it might be. We can generate reports instantly,
Yeah.
but it actually breaks down everything. So this tells us when to get in and out of markets as well. So for those that do get stuck with their serviceability, we can say, well, you have 4 properties. These 3 are still growing. This one's doubled in 5 years, started to max out. So from there, why don't we sell that one, go into an emerging market? But even things like the buy affordability, this is how much of someone's income goes towards their property expenses.
Yeah.
So we kind of want to see that sitting at 30%. If we go to market, I think it was like Burley Heads I was looking at the other day. The buy affordability was like 91, 92%, meaning most people are there are leveraged and a lot of their income's all going straight there as well.
Yeah. With this data, you're obviously getting suggestions and recommendations of suburbs and cities based off, what it's fed in. Who makes the final call on the actual property purchase?
Yeah, it's such a great story because they say data is like a bikini. It's fun to look at, but it doesn't give you the full story. With data and AI and all the machine learning, it's great. It can obviously do a lot of the legwork, but you still need a human element to go over the top of it. One thing about this, like, you might look at a mining town and the numbers are astronomical, and the AI is going to tell you it's growing astronomically because of this actual one stream economic factor that it has there. So at a human level, we've got to look at that and think, well, even though the numbers look great, we're not touching a mining town. So we do have to cross-reference things. Like, we wouldn't touch mining, military, tourism. Has to have at least 4 key economic drivers: health, agriculture, education. So you can get multiple cycles. I guess property, as you know, it's you make good money in the first cycle, but you make your real money when it comes to the second, third, fourth cycle.
Yeah. Yeah, I'm keen to get your thoughts on the Melbourne market. To me, it seems low compared to the other states. Have you got an opinion on Melbourne?
Yeah, it's such mixed feelings at the moment. So obviously, it hasn't done anything for 7 years. Obviously, for a lot of reasons, with obviously new legislation. Brisbane and Perth have become more expensive than Melbourne, even though it's about to become the largest city in Australia. So we were very bullish on Victoria. We got in right at the start of the cycle. As time has transpired, some markets done really well. We've put out of other markets like Melton in Victoria. At one stage, that had the highest growth corridor in the country, but socioeconomically, it was actually one of the lowest places we've ever bought in. And there was so much trouble with obviously trying to do inspections. And obviously with Victoria, you can't pull out unless it's a major structural defect. So we've actually pulled out of Melton because of all the issues, obviously getting a bad tenant in there, but then also the rents were so low there, it just didn't make sense to keep on buying.
Yeah.
So Victoria as a whole, areas like Geelong, Ballarat, Latrobe Valley, Shepparton, regional looks like it's going to outperform the metro for the next couple of years.
Yeah.
Metro Melbourne, we're still buying in pockets, north and west. So, and we're not doing too many purchases now there as well. Yeah, it's an interesting market because you think at hindsight it would absolutely perform. When you look at the numbers, it's not performing as astronomically as we thought it would just yet. It could be a bit of more of a longer term play at the moment. So
Yeah. What do you think the regional is going to outperform the metro there?
yeah, it is a great question. We're just when we're seeing the amount of demand supply in those areas as well, the multiple economic drivers that these areas, the infrastructure projects, they talk about PI, population, infrastructure, employment, those type of areas like Geelong, Ballarat. And then the biggest thing that comes down to is the affordability. So for the price points people can buy in those markets now, just sets a really good, bar for people to be able to get in, much lower entry point. And obviously, Victoria's a much smaller state than areas like Queensland and New South Wales, WA. So regional areas will never touch rural, but regional, it's not too far from the CBD there as well.
You can get 50 minutes, I reckon, from the actual CBD. Actually, Northeast Link's coming up as well. There's even quicker ways to get to the city.
Being in Victoria yourself, what's your actual opinion of the Victorian market?
Yeah, I'm a bit biased because I invest in Melbourne and then I also live here. But, that does give me some advantage because I know the areas, like I've done my own research on the surrounding suburbs. I think, if you look at Sydney, compare New South Wales to Victoria, I don't think it makes complete sense. I think there's too much of a disparity. This isn't great to say, but I don't think Sydney's 50% better than Melbourne, even though the price reflects that. So in my mind, there is value that hasn't been priced into Melbourne.
And they always say Melbourne's 5 years behind Sydney. So when Sydney takes off, people can't afford Sydney after a few years. And then obviously Melbourne starts again.
What's something you've recently changed your mind on for purchasing properties?
It's actually a good one. So I was very adamant that I would never buy something I can't add value to. So everything I bought, I wanted to be able to add value to. And I started doing it at a lower price point. And I realized a lot of times at lower price points, adding value doesn't really stack up as much. Under a certain threshold or a certain price point, it's probably best to just buy in a high growth area and just maximize it.
Yeah.
And then obviously when you want to start adding value, probably do it at a higher price point. It's the same price to repair a roof in a $2 million area than it is in a $500,000 area. You don't want to overcapitalize. And if you're injecting that money in there, you're doing it so you can redraw the equity and go again. But it's one of those things, you're tying up so much money. So you really want to maximize every dollar you're putting in there. That's probably better at a higher price point rather than adding value. Just obviously keep that money, get into another property, now have two properties. If you've got one 500,000 property grows 20%, you made 100 grand, two 500,000 properties that grow 20%, you made 200 grand.
When you say adding value, are you doing renovations, granny flats, developments?
So I was doing renovations. I just finished this one over in Perth. So I bought it for 447,000, renovated the house for 23,000, and then subdivided it. So I still got the house, subdivided it, and a block of land.
Yeah.
I think this is a conservative valuation, but it's coming at 1.1 million. So all in, it was for about 520. Valuation's kind of about 1.1, and that's within less than 2 years. And then instead of building on the actual new block, I'm trying to transport a house onto it. So it's all about speed as well.
Yeah.
So I found a company where I've got a house where I can transport it, install it onto the block of land. A lot of people are obviously trying to demolish their houses, cost 50 grand. Companies out there say, we'll take it away for you for free. So, or you can even do it yourself, buy on a Gumtree. But I just wanted to make sure I got it right for these first few. So I'm transporting, installing it. That all up from buying the property and installing it onto that block cost about 300 grand. I know I can get it instantly revalued for about 850.
Yeah.
So about another $500,000 there, all up on a 447,000 purchase within just over 2 years. I should make about $1 million net profit.
Yeah. Wow. And
So
why is speed so important there? Is it because of the holding cost?
Yeah, it's just the opportunity cost as well, being able to get into other markets as well, just get in and out quick, redraw the equity. That's one thing I realized in bigger developments, just how much money you're injecting into it, and you're kind of stuck for a longer time until, I guess, the development kind of matures. So if you can get into these markets as quick as possible, the longer time you can spend in those markets, even though our whole ethos is about timing the markets, we still want to complement it with time in the market.
Yeah. So we chatted about that before, how important it is to have a team of professionals. We're going through like a quality broker, quality buyer's agent, quality accountant, quality advisor. When you have that team on your side, it's like all your risks can kind of be flatlined in terms of you just have this wealth of knowledge and a team behind you that's going to actually give advice and then implement that strategy as well.
Yeah, it's good to learn from mistakes, but it's much better to learn from someone else's. When you're the head, you don't need to be the arms and legs. So kind of put yourself in that position where you've got other people doing it for you.
I'm curious to know, what makes a good client in your book? Are they ready to go with purchasing properties and then moving quickly? Like, what do you see success in your business?
As much as we talk about trust, and people do trust us and let us do our things, we do want them to be involved to a degree, even though they're paying us to do everything. We still want to kind of educate people on the process, and we want people to speak to the building and pest inspector. Even though we read through the whole report, highlight everything is notable, it's just good for them to be across it as well. We, as I say, obviously trusting us, but also still doing a bit of their own research so they feel comfortable with all that. In regards to their profile starting, the areas we're buying in probably only need about $100,000 in cash or equity. And that will cover everything: building pass, solicitor, stamp duty, everything they need. And serviceability, that's a big one. If they can service anywhere from 500 to $1 million. And I think also having that accumulator mindset where it's not just one property. They understand real estate and the investment strategy of, let's buy this one as a stepping stone to get to the next one. So it is something we've been a lot more aggressive on, because we saw the results we're getting people that they could redraw the equity in 6 to 9 months and buy another property. Yeah. People just didn't understand that.
Yeah. Is there a certain risk profile that your company attracts? Obviously, you have to be comfortable with an amount of debt.
Yeah, it is such a great question, because we actually asked that in the onboarding, how risk adverse are you? And some people are so risk adverse where we'll only ever put them in a metro market. Other people are like Gladstone got 30% year on year in their suburbs we're buying on. So those properties just skyrocketed where they could redraw the equity and buy multiple very quickly. But somebody that was very risk adverse, we would not put those markets in there. So that's something we do look at, what's understanding for them. Some people want where they get a bit too emotional and they're looking at stuff that they would live it themselves.
Yeah, there's a lot of emotion, even with investment properties. Like you get attached to a certain property, certain type, and it's hard to let them go, even if it's not the right purchase for them. Do you have many people coming in, their borrowing capacities maxed out? Are you telling them to sell maybe in their personal names so they can kind of re-go, use a structure, and then kind of have this bigger landscape of servicing?
It's a bit of a gray area because telling somebody to sell kind of borders on financial advice. So,
Yeah,
so we'd
true.
rather just pass them to yourself, and obviously you can look at their holistic situation. What we can show people is where the market and where the market's heading in the areas they own. So a lot of times people bought off the plan apartments in major metro cities, like obviously Melbourne, they've really grown much in the last decade. In Sydney, it's like Parramatta, those areas. So with that, we do show people the opportunity cost and say, hypothetically, if we build your strategy, this is where you're at now. But if you were to get rid of that debt and reinvest it, this is what your strategy looks like now. So we can show people from a property perspective.
I'm curious to touch on that point because, just say the market cycle is done, there's still obviously costs involved in jumping into a new market, right? You got to sell, there's agency fees, you're repurchasing, so you have stamp duty again. So obviously there's a financial trade-off, but obviously if you see the benefit of going to a new market, you're still going to earn more than your cost. I'm assuming that's when you make the jump.
It's one of those things we try and tell people, if you can hold it, that's great. If it's the right asset, a great example is Harvey Bay. It's shot up about 60% in 2 years in the markets we're buying in. So even though I'm saying these holistic areas, we're very selective on the suburbs we're buying in.
Yeah.
So in those particular suburbs skyrocketed, and people saying, well, should I sell? Because Harvey Bay started to plateau. We said, no, actually hold on to it. A couple of reasons. It's in an area with multiple economic drivers. So we'll have multiple cycles. Secondly, if it's not positive cash flow from the first day, depending what size deposit, it should be positive cash flow in a few years. That's our goal. So it's not holding you anything to keep. If you can redraw the equity and use the bank's money, you avoid all the capital gains tax, the transaction fees. Property's very expensive to get in and out of.
How important is earning a good income to your selected strategies?
I should touch upon that as well. With high rental incomes, we believe in interest only rather than principal interest and not paying off the actual debt itself. The reason for that, typically properties will grow faster than most people can save. When you've got principal and interest, it's obviously a much bigger expense against your name. Therefore, it's hurting your serviceability to get to the next one. Holistically, if we look at it, people will make more money by owning multiple properties in high growth areas rather than just trying to pay off one. The reason for it, residential property Australia, world's greatest capital growth asset class because you can borrow so much money. It's still not the greatest for cash flow. Like if you go to the US, the yields are like 10 to 12%. You go to Europe, it's much like that. The average yield's about 3% here. I'm talking gross yields now. It's probably 1.5% net. So we want to make those gains and then transition into cash flow assets. So it'd either be selling down your portfolio, use the gains to then pay down and have multiple fully paid off properties, or going to things like apartment blocks or commercial where you are now getting a much higher rental return, but they're quite high risk. And that's what I was saying earlier as well. We want to enter those type of assets at a much, much higher starting point. You can buy commercial properties for 100 grand in rural Queensland. They could sit there vacant for years.
What do you think people often go wrong with purchasing properties?
I think people focus on cash flow way too early, and everybody wants a positive cash flow property. With everything as it is now, you probably need about a 35% deposit, and would much prefer positive cash flow. Everything we bought in 2022 was positive cash flow from the first day. People get fixated with that. Secondly, people get way too emotional. Again, it comes back to tangible asset. Will they live in it themselves? And it is people's life savings, so we do understand that. Buying your own backyard as well, just because to them they feel that's comfort, they know it, but they don't understand the numbers. And the key to real estate is buying the right market at the right time for the right price. Every suburb's on a different property cycle. That's why you use all the AI and the machine learning to understand where every suburb is in its growth cycle. And I think the structuring as well, we're just obviously not getting the right team around who's going to advise them on what structure they should put in and how they should really kind of sequence their property purchases and obviously checking everything off in regards to making sure that they're actually doing their due diligence. Things like buying near a transmission line now, banks will only value those properties at 80% if you're too close to a transmission line, or buying near public housing, things like that that people don't look for.
Yeah, if we think, just say we have a 19-year-old, they're interested in purchasing property, what are the do's and don'ts of going about, doing your own research, whether that's, researching buyers agents or it's, getting advice? What should be happening?
I'm talking from two perspectives, obviously the buyer's agent side, but also the property side. Firstly, value's always on land. Don't touch apartments, house and land, off the plan, especially now with some of the changes. It sounds like all the investors are going to flock to those house and land type packages. Whereas it's not so much the property that grows, it's the markets that grow. I'd also say buy in areas where there are multiple economic drivers. Don't want to buy in those mining towns or any of those rural areas. I'd say, lastly, it's understanding the real money is always going to be in the capital gains, not the cash flow, and being mindful of that. So I'd say starting price point, the earlier you can get in, the better. But as long as it's a good quality asset, because so many people have bought these off the plan apartments as their first place, and it's stayed the same, but economically it's actually gone backwards because obviously inflation has devalued our dollar. So even though it's the same dollar amount now as what you bought it, it's actually worth less. Plus what your transaction fees. So sometimes it's not worth getting into those assets. It's probably best to hold on a little bit more. I guess from a buyer's agent, it's the top 5 fastest growing industries in Australia at one stage. There was over 3,000 buyer's agents. There was obviously a lot of cowboys out there just flogging developers' stock, one-man bands working out their basement. I'd say it's definitely looking for established companies that have a mindset of building a portfolio rather than just a one-and-done buyer's agent where they just dump you with a property and never hear from you again. Obviously, you can look at people's reviews as well, which obviously really gives a good testament. Just understanding their ethos, their strategy, where they're getting paid. So we don't accept referral fees or kickbacks or anything. Whereas if they're getting paid by a developer or somebody like that, they're more incentivized to push that way. What about yourself? What's your outlook for the property market over the next 12 months?
I think there's a storm of reasons not to buy for investors: high interest rates, policy changes. Obviously the government's trying to make it not an investable asset. In my opinion, that's the best time to strike, right? It's like you're kind of in a buyer's market in terms of you have the terms on your side. I think you could do a lot more negotiation as a buyer at the moment. And prices, in a lot of markets have been stagnating or decreasing. So in my opinion, even though the uncertainty is high, it's the best time to buy.
Yeah, exactly. 100%. It's the best time to buy is when there's blood on the street. And even though they're trying to, sorry if I get a bit political here, even though they're trying to frame it as a helping first home buyers and all that, there's nothing that really helps first home buyers. They're not obviously reducing their taxes on their incomes to help them get in or anything of that sort. It does seem like everything's just a massive tax grab. It's the reason why they're pushing to new builds. Over 40% of when you buy a new build property, it's just taxes to the government with obviously stamp duty and all the taxes you pay throughout it. So $1 million purchase over 400 grand is just tax grabs as well. It's obviously trying to get rid of negative gearing and capital gains tax. So and the reason why I say that, it hasn't changed the real issues. It's the supply issue. There's still a huge undersupply of properties coming in. They haven't done anything to help that as well. As I was saying, 30 years ago, it was faster to build a house than now. So they're not doing anything to get rid of the red tape.
No, you're right. I think a lot of what the government was doing didn't make a lot of sense. Everything from, putting capital gains tax on all asset classes, to grandfathering, to not really addressing the supply issue.
Yeah, they said the governments don't make money, they take money. And this is pretty much the main source of income. And it's unfortunate that the people we work with we do have such a huge spectrum from people that couldn't afford to live in the area they wanted to live, so they got these smaller budgets, to people who have sold tech companies for over $100 million. But the majority of people that we're working with, they're just middle to a little bit above middle income that obviously have a bit of money on the side, especially if they've bought something in areas like Sydney over the last 12 months or 5 years to live in. They've got sitting on equity. So unfortunately, it's not hurting super wealthy people. It's hurting the people that just want to get ahead a little bit. And property's already quite hard to hold. But hopefully rents look like they're skyrocketing as of today. Biggest quarter have had rent increases in the last few years.
Where do you think Australia is heading from just a financial standpoint?
That's the thing. Like the last GFC we had, where markets around the world were crashing, Perth grew 139% in 3 years. And That's where, even though in the current affair and the morning shows might be talking about the Australian property market, there's no such thing. Every suburb's on a different property cycle. There's always money to be made somewhere. Even so, we're only about 70 suburbs. We're completely agnostic. We just follow the data. So I do think obviously rents will jump up a lot, just because if investors do start to leave the market, the areas we're buying in a very owner occupier focus. So there's not many rental properties anyway. So if they leave, there's now more of demand. I think it's about 40% of Australians are living paycheck to paycheck. So even if property prices halve, they still couldn't get into the property market. When you think about your stamp duty and your deposit sizes and all that as well. So there's a need, there's an absolute necessity for rental properties.
Yeah.
So by the sounds of it, rents are going to jump up, make it easier to hold property. When rents obviously start to rise, it's completely inevitable that then property prices start to rise. People start to question, why am I renting when I can buy? So if rents start to skyrocket, not building enough houses, it's going to be inevitable that property prices start to go again. So it's just such a great time to buy.
Justin, if people want to find out more about you and the investor agency, where should they look?
Yeah, so obviously we've got a website, the Investors Agency. Obviously we're on all the socials like Instagram. The big thing as well, if people just want to obviously book a call and we can take them through, we can build personalized strategies and all that. The AI allows us to do so much so quickly now as well. So yeah, people just want to go to the website, theinvestorsagency.com.au. They can book a call. We only do in-person or video calls. We don't do phone calls. And we don't have those, we're not one of those companies where they spend 20 minutes talking to a setter trying to qualify them. We don't do anything like that. We just try to show people the entire process. They can see if it aligns. We'll be very transparent. The markets we're buying in, just so there's no surprises, and they can just come straight in. And if it aligns, it aligns. If not, at least hopefully they haven't felt like they're being sold to, or it's been some sleazy sales presentation. So.
Thank you, man. Pleasure.
Thank you so much, man. Appreciate your time.